Hi everyone. I trust all you are doing well. So in previous video, we have discussed that how you can prepare an income statement for franchisee business. We have taken several assumptions, right? And on the basis of assumptions, what we have done, we have constructed a profit and loss account. So we assumed, right, that this is going to be our income. And accordingly, we have calculated the income for 5 years. Then we have taken here the cost, right, for 5 years. And on the basis of this, we have calculated, the cost which you will incur in coming 5 years. And after that, we have calculated the EBIT, right? So we have taken the total expense and total sales, and we have calculated the difference between these two values, and we got here EBIT. Then we have subtracted the interest here, so we have computed the EBT, and from EBT we have subtracted the tax, and we got here the net income amount. Right? Now, what we have to do, we have to calculate the value of business. Now, there are two terms for value of business. One is free cash flow for equity, and one is free cash flow for firm. So, what we will do here, we will calculate the value of business on the basis of equity. Because here you are trying to find out that how much return you will get after payment of all the expenditure. So in coming lectures, you will get great idea about FCFE and FCFF. What is FCFE and what is FCFF, right? Right now, we do not want to get into this, right? We will only calculate the value of business. So let's suppose if I'm planning to start a franchisee business, so what value I will receive from this business? That is my goal here. So let's calculate the value. Now, if you want to calculate the value, so we need to find out the FCFE, right? We need to find out here the FCFE. FCFE means free cash flow for equity. FCFE means here free cash flow for equity. That how much return equity shareholder for will receive from this business. So free cash flow for equity we have to calculate. Now here there is a formula to calculate free cash flow for equity. I will explain you this formula. First, let's find out the value here. So formula is here net income. Formula is here net income. Then we have to add here the depreciation and amortization cost. If there is any non-cash adjustment we have made, that we have to add, right? So in this example, we have not provided any adjustment for depreciation and amortization. So we will add here depreciation amortization. Still, we have to provide the adjustment. So then after that, what we have to do, we have to, add the capital debt borrowed here. We have to add here the debt borrowed or capital raised. So here I will write down debt borrowed, right? And we have to subtract here the debt repaid if you have paid any debt. So that we have to subtract, right? If you have made any capital expenditure, so what we have to do, we have to provide the adjustment for capital expenditure, right? We will provide the adjustment for capital expenditure here. And we have to also provide the adjustment for working capital, right? We have to provide the adjustment for working capital. Here we have not discussed much about working capital, so you do not have to worry. This we will discuss in coming lecture. So here we have to provide the adjustment for working capital, right? So here, once you will provide these all adjustments with the net income, you will be able to calculate the FCFE, right? The net result is going to be here, the FCFE. Now we have already calculated here the net income. So what I will do, I will copy these values from here, right? This is the net income. Depreciation and amortization is not taken in the example. So here, this is going to be zero, right? This amount is going to be zero here. So I will take zero. Debt borrowed, right? Now in first year, what we have done, we have borrowed some debt, right? Here you can see information related to debt is given, which is 65 lakh 50,000. So here I will take debt borrowed amount, right? So let's add here the debt borrowed. We have to take this value in lakhs. So I will divide this with 1 lakh, right? So debt borrowed is somewhere around 66 lakh, right? Debt repaid is not given. We are not repaying we have not repaid any debt, or we are not repaying any debt in first 4 years. So in first 4 years, it is going to be zero, right? In first 4 years, it is going to be zero. And at the year end, what you will do, you will repay the debt, right? So this value is going to be negative. We have seen that after 5 years, you will repay the debt, right? So this we have to take in lakhs. So I will divide this with 1 lakh, and here you will repay this much, that is 66 lakh, right? Then you can see here capital expenditure. So what we have done capital expenditure, right? How much capital expenditure we have done? We have renovated, right? We have done renovation, which is 65 lakh, right? We have done the renovation here, that is 65 lakh. So what I will do here, I will subtract the capital expenditure. right? The capital expenditure is of how much? Here, capital expenditure is of 65 lakhs. So here we will take the value that is 65 lakh and we will divide this with uh, 1 lakh. We will divide this with 1 lakh here. Right. So here you can see this is the capital expenditure, which is 65 lakh. And here, what you have done, you have made initial investment, right? You have made initial investment. So you will receive the amount which you have deposited, right? You will receive the amount which you have deposited, that is 66 lakh. Now, here, this amount you will receive, after 5 years, right? Let's suppose in 5 years you will close the business, right? So here, after 5 years, you will receive this amount. So if you want to, showcase that you will receive this amount after 5 years of deposit amount, then what do you have to do? You have to show this initial capital expenditure. You have to show the total capital expenditure, which would be 131 lakh. And at the end of fifth year, you will receive how much? You will receive 66 lakh deposit, which you have paid back. Right. So I will ignore the deposit adjustment because initially you will deposit and at the end you will receive this amount. So we can ignore this adjustment for right now. Right. So we will ignore this adjustment. Working capital adjustment, we do not have to provide. So this is going to be zero for all the years. Right? This is going to be zero for all the years. So here now what I will do, I will add these numbers and we will calculate the amount. So 65 lakh plus depreciation amortization, which is not given here. Debt borrowed we have to add. Then we have to subtract here the debt repaid, which is zero. We won't repay this in current year, right? Then here you can see capital expenditure we have to subtract, that is 65 lakh here, right? Then working capital change is not given here. So we will take this value and here instead of minus, I will take positive value because here in formula I have subtracted this. So here you can see this much is going to be your FCFE, right? This is going to be your FCFE, that is free cash flow for equity. Okay, that is going to be your free cash flow for equity. Now here what I will do, I will change the formatting because it is difficult to read with the currency. So I will remove this currency format from here. Let's remove this currency format and I will take your numbers. Right, let's take your numbers so it is easy to read. It is easy to read. So I think now you are able to read it properly. So here, this is going to be free cash flow for equity, right? If you want to provide the adjustment for this initial deposit which you have made, you can provide the adjustment for this. That is okay, right? That is okay here. So what we have done, we have calculated the values here, right? This is the FCFA. Now what you can do, you can calculate the present value of these amounts, right? You can calculate the present value of these amounts and you will be able to calculate the present value of FCFA. Now we have to do few more adjustments here, right? So let's do some more adjustments. So you will be getting more and more understanding. So here, how much you have invested? If I talk about initial investment, if I talk about here initial investment, so your initial investment is of 131 lakh, I think. Yeah, it is 131 lakh. Right? This is your initial investment. How much you have invested is 131 lakh. So I will divide this with 1 lakh, right? So here we will get the numbers in lakhs. This is your initial investment, and this we will show with negative figure. Right? This we will show with negative figure. Now here, how much returns you will generate? This is going to be your return amount, which you will generate from your business. That is the FCF figure, right? So what I will do, I will bring these values, and here I will write down cash flows. Instead of initial investment, I will write down here cash flows. So on day zero, when you will start the business, this much is going to be your initial investment. And here you can see these cash flows you will generate in coming 5 years, right? This much cash flow you will generate in coming 5 years. Now here, what we have to do, we have to calculate the overall return, right? If I have invested this much, so what return I will generate from the business? This is what I have to calculate here. Now here, what we have done, we have taken initial investment that is 131. So what I will do when I will record here capital expenditure, so instead of taking only and only renovation cost, I will take the complete cost. I will take your complete cost that is 131 lakh. I will give you the reason why I'm taking 131 lakh. I have not only taken here 65 lakh because we have to calculate the present value also. So we will calculate here the present value also. So here you can see this is the capital expenditure, right? And at the end you will get back this deposit amount which you have deposited initially. So here I will write down this value which is 66 lakh. Right, I will write down here this value which is 66 lakh. Right, so this has to be divided with 1 lakh. Right, this has to be divided with the 1 lakh. So here this should be in negative, or here we have to add this value. So what I will do, I will add this 66 lakh. We have subtracted here this 66 lakh. right? We have subtracted this 66 lakh. We will get back this amount, right? So here, in this case, what I will do, I will add this capital expenditure because here there will be a positive flow. So here I will add back this amount. So this is going to be 141, right? So here what we have done, we have calculated the FCFE. We have calculated the FCFE here, right? You do not have to confuse this with this point. Initially, we have invested 131, right? Initially, we have invested 131. And at the year end, what we will do, we will get back this amount. So here, what I will do, I will write down add and less. Right? I will write down here add and less. So here we will get back this money. Right. So here, if I want to calculate the IRR, right, if I want to calculate the IRR, IRR means internal rate of return. This we have discussed in capital budgeting chapter. So it will give you that what overall return you will generate from the business. Now in Excel, it is very easy to calculate. What we have to do, we have to apply the formula that is IRR, and we have to select all these values, right? We have to select here all these values, and we will calculate. We will be able to calculate this answer. So your IRR is going to be 41%, right? Your IRR is going to be how much? Your IRR is going to be 41%. It means you will get return of 41% from this business. How much return you will get from this business? You will get return of 41% from this business. I think you understood, right? How we have calculated your IRR. So this is going to be your return. So if IRR is positive, what you can do, you can proceed with this business, right? What we can do here, we can also calculate the present value. Here, what we can do, we can calculate the present value. Now you have to understand that whenever we calculate the present value, so we need discounting rate, right? We need discounting rate here. Now, if you want to calculate the discounting rate, so first you need to find out the weighted average cost of capital, right? Now here we know the cost of interest. The cost of interest is how much here? It is 13%. So here we know the source of fund. So source of fund is here equity, which is 65 lakh 50,000. Debt is 65 lakh 50,000. Here, if I talk about the weight, so weight is going to be obviously 50%, right? Each. So your weight is 50% for equity and 50% for debt, right? And we know the cost here, right? So cost of debt is given, that is 13%. But you have to understand that in case of debt, we are eligible for tax benefit, right? In case of debt, this I have discussed in detail. In case of debt, we are eligible for tax benefit. So here tax rate is 30%, and if I calculate the net interest cost, so here it is going to be 13% multiplied with 1 minus 30%, 1 minus tax rate. So that is going to be the net interest cost, right? If I want to find out the equity rate, we have discussed about the CAPM model, right? If you remember, we have discussed about the CAPM model in detail. So let's suppose here cost of equity is 12%. I'm making assumption here right now. So if I want to calculate here the weighted average cost of capital, so what I will do here, first I will multiply the weight with cost. So this is 6%, and then we will multiply weight with this cost. And here we can do the total. So the total cost of capital is 10.5%. This is the total cost of capital here. So we can consider this as the discounting rate. What we can do here, we can consider this as the discounting rate, right? So here discounting rate is how much? It is 10.5%. So here we know the WACC, which is 10.5%. And now what we can do here, we can calculate the present value. Right here, what we can do now, we can calculate the present value. So what I will do here, I will apply the NPV formula. Right, I will apply the NPV formula. This formula says that first we have to write down here the rate. Right. So let's take your rate. Rate is 10.5%. Right here, rate is given 10.5%. After that, what we have to do here, we have to select the values. Right. After that, what we have to do here, we have to select the values. So we can select all these values. Right. Here the data should be. Yeah, here we can select the values. Here the NPV is 157 lakh, right? This is the NPV here. How much is the NPV here? NPV is positive. If you see NPV is positive here, that is 157 lakh. Now we can also calculate here the present value of cash flows, right? So we have discussed a lot about present value of cash flows. And now what I will do, I will calculate the present value of cash flows. So if I want to calculate the present value of cash flows, I can directly use here the formula. So here, let's first calculate the present value of cash inflows, right? So here we will calculate the present value of cash inflows. flows, right? So what I will do here, I will apply the function that is NPV. In Excel, what you can do, you can apply the NPV function and you can calculate this value. So here, let's apply the NPV function. So we will be able to compute the present value of cash inflow. So first we have to take your rate. So let's take here the rate, right? So rate means weighted average cost of capital or cost of capital, which we have calculated. That is 10.5%. And we have to select the cash flows here. Now you have to remember that which cash flows we will select here. We have to select the cash inflows only, right? So these are the cash inflows for first 5 years, right? Here, this is the cash outflow. And these are the cash inflows for first 5 years. So here we have to select the cash inflows only, and I will press enter here. So this is going to be this is the cash inflow. This is the present value of cash inflow, right? If you will do the total of these values here, if you will do the total of these values, so how much you will get here? It is 440, right? But here, why we are getting different value? Here we have calculated the present value of these future cash flows, right? If you directly calculate this value, so here the value which you will get, that is 440 lakh, right? You will get here 440 lakh. So how much inflow you will be able to generate from this business? Present value of inflow, that is 304 lakh. What I will do, I will convert this into lakh now, right? So it will be more readable, right? It will be in readable format. So how much cash inflow you will generate from the business? You will generate cash inflow, that is 3 crore 4 lakh 84,000 in 5 years. Now here we know the present value of cash outflow, like we already know the present value of cash outflow, present value of cash outflow here. So I will write down here the cash value, present value of cash outflow, that is 121 lakh, and I will multiply this with 1 lakh, right? So here you can see this is the present value of cash outflow. This much cash outflow will be there in your business, right? So if I ask you that what is going to be your net present value, so simply we will take the difference between cash inflows and cash outflows, right? So let's take the difference here. So here your total return would be 173 lakh, right? This is going to be your total return, right? That is 173 lakh. So definitely what you should do, you should start this business, because this business will be giving you yearly return of 40% around, right? Approximately you will receive yearly return of 41%. And here the net present value is 173 lakh, which is positive. So you are able to, you will be able to generate the great return from this business. Now, what you can do here, you can do the sensitivity analysis also. Like, so we have seen this whole data, and now we can do the sensitivity analysis. Now, here you have to see this data that we have borrowed debt, right? We have borrowed debt, due to which our overall cost of capital is lesser, right? Here, our overall cost of capital is lesser here. If you will change this proportion, if I take here 40%, right? Let's suppose here equity is 60% and debt is 40%. So you will find that our IRR will change, right? Here there's no effect on IRR, because here we have not calculated the present values. We have taken this direct value. Here you will find that our net present value changed here. Previously, net present value was how much? The net present value was somewhere around, if we take the old proportion only, that is 50 and 50%. So here our net present value was 173 lakh. But when I have changed the proportion here, I have taken 60/40. So here, this value got changed, right? This value got changed here. So that plays a very crucial role, right? It will affect your IRR, right? That will affect your IRR. Apart from that, you have to understand that your NPV will also get affected. So what you can do here, you can do the sensitivity analysis. So currently, how much is your IRR here? The IRR is 41%, right? IRR is how much here? It is 41%. And what I can do, I can change the debt proportion. I can change here the debt proportion. Let's suppose debt proportion is 20%, right? 30%, then 40%, then let's suppose 50%, then 60%, right? And here we can take 70% the debt proportion. And what I will do here, I will convert this into percentage. Do not worry. Here we can convert this into percentage. So here, this is the debt proportion, right? And here IRR is 41%. You can see, right? Now here we know the cost, right? We know the cost here. So cost of debt is 13%, which is given in the question that you can see here. Cost of debt is 13%. So obviously, if you will borrow more debt, your cost of debt will change, right? I think you might be knowing about the marginal rate. So here, the more debt you will borrow, your cost of debt will change. The lesser debt you will borrow from the bank, so the interest rate will change. So here, let's suppose I'm assuming 11%, 12%, then 13%, then 14%, 15, 16, 17, right? So here I'm considering these interest rate. Let me convert this into percentage. Let me first paste it here. And let's convert this into percentage. So this is going to be your percentage. Now what we can do here, we can do the sensitivity analysis with the help of this given number. I will explain you that why I've taken, some data. Here we have to select this whole value. We have to select this whole value. Then we have to click on the data, right? I have discussed this in Excel sessions. Here, what we have to do, we have to click on the what if analysis. And here, scenario manager is given, goal seek is given, and data table is given. So what we have to do, we have to click on the data table, right? And row input, right? Row input is given. So we have seen here that we have borrowed debt, that is 50%, right? So we are now sensitivizing this debt proportion, right? We are sensitivizing this debt proportion, right? So we will change this with 20%, 30%, 40%. And here we know the rate also. So under column, what we have done in column side, we have taken the rate. So your interest rate is 13%, right? So here we have to press OK, right? We have to press OK here. Now you can see we got the numbers here, right? We got the numbers here. So we can convert this into percentage. Right. So here you can see the more debt you will borrow, your IRR will increase here. Right. Currently your IRR is how much? It is 41%. Currently your IRR is how much here? It is 41%. Right. So if your debt or if your business is able to generate, more return than debt, right? If your business is able to generate more return than debt, how we can find out this? Here we can see that your internal rate of return is 41%, right? Your internal rate of return is how much it is? 41%, whereas debt cost is 13%. Whereas debt cost is 13%, right? Your returns are more than your debt cost. Now here, if you see, if you will borrow only 20% debt, right? If you will borrow only 20% debt here, so your IRR will reduce. Right? You can see here, your IRR will reduce. Right. Then if you will borrow 30% rate, 30% debt and 70% equity, your IRR will again be lesser, but it is going to be more than 20%. Here, if you will borrow 40% debt, your IRR will be lesser than the actual IRR, which is 41%. You can see here. If you will borrow 60% debt, now your IRR will be more than 50% or more than this existing IRR, right? So previously we have seen that we have borrowed 50% debt and IRR was 41%, right? IRR was how much? It was 41%, right? But if you will borrow more debt, your IRR will increase here. You can see your IRR will definitely increase. So I think you understood this, right? And you can do some formatting when you will present this in front of investors. So you need to showcase the formatting also. Proper formatting should be there. So here I can write down the debt proportion. So this is the debt proportion here. So we can highlight this separately, right? And here what you can do, you can write down the interest cost. So here I will write down the interest cost, right? This is going to be the interest cost here. So I will write this into center. Then we can do the proper formatting. Yeah, so this is going to be the interest cost. If I copy this, if I cut paste this into other cells, so we will be getting some space here. Okay. We have merged these cells, but anyways, here I can do like this. So this is the interest cost, right? This is the interest cost, and this is the debt proportion. And I think now you got the idea, right? How we can do the sensitivity analysis. So you can do more formatting here to present it better. I won't give my efforts towards formatting much, right? Because you can do it by your own. Here, what we have done the sensitivity analysis also. Now, you might be finding these concepts new if you have not revised the previous concepts or if you have not watched the previous videos. So my suggestion is go and watch the previous videos. We have discussed financial management in detail. We have discussed corporate finance and financial reporting in Excel. So go and watch those videos. So you will be getting more and more clarity about these concepts. Now, in coming time, what I will do, I will discuss more and more models. So you will be getting more clarity. So this was the basic model which I have covered. So you should get idea, that how does models are prepared. This is the very basic model. Now, what we will do, we will prepare more advanced models where you will learn, right, that how to do the valuation of business. You will learn various terminologies, various formulas in detail. So thank you. Thanks a lot for watching this video and go and watch the remaining advanced models and you will learn a lot about financial markets. Thank you.